Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Greg Person, Senior Vice President of Sales and Account Management at Kyriba, as well as Zach Brown, Executive Vice President of Product at ICD. They join us to discuss how CFOs are adopting automation and AI for treasury functions such as liquidity planning, risk management, and cash forecasting. Gentlemen, it's great to have the both of you with us. Welcome to Trade Talks. And Greg, we'll kick it off with you first. If you could just give us a high-level overview of where Kyriba sits within the risk management ecosystem.
Yeah, absolutely. And thank you, Jill. Thanks so much for having us on here this afternoon. Sure. So yeah, at Kyriba, we're a global leader in liquidity performance. And really what that means is we're helping CFOs, treasurers, IT professionals connect into their overall liquidity landscape. So that's bank connections, ERP connections, really all the sources and uses of cash that helps them optimize and protect their liquidity both now and in the future. So we do that now for over 3,000 customers around the world. We're processing as well lots of bank transactions through our system that kind of helps execute that liquidity strategy. So we're moving more than 3.5 billion bank transactions per year. It equates about $15 trillion in annual payments through our platform.
Right. And Zach, tell us about ICD and where you sit within the risk management ecosystem.
Yeah, thanks, Joe. Glad to be here. ICD offers a short-term investment marketplace and execution and investment reporting technology focused on the corporate treasury team within the office of the CFO. We offer two primary products. First is our investment portal, which offers hundreds of short-term investments and support for the full trade lifecycle of those asset classes, as well as a system called Portfolio Analytics, which is an AI-enabled risk and exposure analytics platform that allows reporting to aggregate data about corporate treasury team's entire investment portfolio.
Right. And we'll certainly touch on AI, of course, and automation at the latter half of this conversation. But Greg, let's kick this off. How are CFOs managing bank exposures in the wake of past and even future failures? It's been a big thing, big topic of conversation in 2023 with what we saw at some of the banks.
No, absolutely, Jill. I think 2023, obviously you're referring to Silicon Valley and what happened last spring. I think that was absolutely a wake-up call to the CFOs and treasurers. So I think we've seen a lot of initial reactions to that, but certainly going forward as well, and how companies are not just looking at credit ratings of the organization or looking at the sort of basic counterparty risk allocation, but getting more sophisticated. As I said, it was a wake-up call, and part of that as well is just the timeliness of how they look at their exposures. Historically, you would find some organizations wait till quarter end and they do a roll up and they would have an audit committee board meeting or something to kind of go through where are those exposures. But I think the wake-up call from last year is a lot more prudent behavior as looking at my exposures. What are they today? What will they be next week, a quarter from now, and making sure there's a nice balance across the risk mitigation on where is my exposure with the counterparty risk measured with the interest rates as well, ensuring that there's a return there and allocating that risk properly across their various counterparty banks.
So Zach, how can you see it? I'm sorry, go ahead.
I was just going to say, Greg is absolutely right. Like 2023 was a wake-up call for the organizations we work with. And we actually have seen that, that continues to push on into 2024. In January, we ran a client survey where 80% of our respondents said that they're still concerned about bank failures, even after the government stepped in and did a lot of things to try to shore up that marketplace. But when we talk to firms in the space, they really focus on kind of three areas that they're really trying to push ahead on in that area. One is just visibility. Greg touched on this, just understanding what your risk is across your portfolio. That doesn't just mean your bank deposits, but it also means things like your underlying exposures through your fund products or any kind of individual positions when you're within your separately managed accounts or your direct investing activity. Also stepping up your analysis. I mean, Greg said that, the frequency at which they're doing reporting has changed. And I think a lot of firms were running on either a monthly or a quarterly cadence when they were looking at things like counterparty exposure. And we've seen people step that up and say, not only do I want to do that, at a much more frequent basis, but I want to make sure that I'm communicating within my organization whenever those exposures change. And then adding new metrics is a big push right now. Greg mentioned ratings as being, kind of a lagging indicator and an ineffective one last year. And so a lot of firms are adding to that data set by adding things like credit default swap spreads and equity price changes in order to really get a better feel for the health of their counterparties. And then the last was just diversification, right? So we saw huge shifts away from any single name exposures to products like money market funds, which provide diversification to enable stability, as well as high levels of liquidity. And we'll talk about this later, I'm sure, but liquidity was a big issue, maintaining liquidity while also gaining diversification. It's one of the reasons why money market funds shot up in across the board for institutions, as well as providing a higher yield. I mean, with the higher for longer world that we sit in today, with the interest rate environment and a inverted yield curve, that really drove a lot of balances towards those types of products.
Well, Greg, let's talk about this some more here. How are CFOs reducing vulnerabilities to rising interest rates? What appears to be we're going to be in a higher interest rate for longer environment, and of course, you have foreign exchange volatility as well.
No, that's true. I mean, obviously, we're not seeing any slowdown. Data continues to suggest that a rate cut, if it happens, will be certainly probably towards the end of the summer. So again, similar to the same concept before about a wake up call. I mean, a lot of CFOs that we work with, group treasurers, they've gotten very used to a very low interest rate environment, and that's obviously changed dramatically the last few years. So kind of balancing that now is ensuring that that cost of idle cash, but the cost of funding has risen dramatically. So if you think about any CFO, he or she has a capital allocation strategy to execute against, right? Ensuring that the share buyback program, retiring debts, or M&A activity, these are all critical things that CFOs are tasked with executing. So with the rising interest rate environment, that cost of capital is certainly more challenging than it was years ago. We don't see really any signs of that slowing down until maybe earliest later this year. Similarly with the interest rate volatility has an impact, of course, on FX rates, right? Interest rate parity driving your FX volatility as well. So that's an age-old challenge. I think that we're going to continue to see high volatility in the currency markets, and all this again drives how do I have the right liquidity in the right region with the right level of risk and cost, and that's a lot what CFOs are challenged with, and the higher interest rates have certainly made that a bit more challenging than we saw years past.
Mm-hmm. And Zach, that was part of the challenge with Silicon Valley Bank as an example. They weren't running, let's call it, enough risk scenarios as it relates to interest rate. They just weren't modeling it out far enough or as high as interest rates have risen.
Yeah, I mean, the changes in the interest rate environment were dramatic, obviously, and we've seen, continued, pressure on that and I guess risk around where that's headed. There was a lot of interest rate drops expected, sooner rather than later. And now that world looks a lot different than it used to just, a few months ago. So I think risk is still at the top of all of CFOs' concerns around their portfolios, around their cash exposures. And I think one of the big things that they need to focus on is reducing their manual processes so that they can maintain that visibility. So, the firms that I talk to, they often will have manual Excel-based processes by which they understand their exposures to things like interest rates, durations, counterparties, and those processes keep them from being able to achieve what they need to when those events occur. And we're not going to know where that next risk comes from, whether it's FX or a geopolitical event or some sort of FX or interest rate movement, a dramatic shift in the curve. All of those things are possible, and without automation, the on-demand reporting that you need to respond to those types of situations is really difficult to get to. And you have to think about that well ahead of when you need it, right? And so you got to think about enabling those technologies well before the event occurs.
Right. Well, I mean, part of the challenges too is that the technology is moving so quick, and Zach, you and Greg have been saying over and over again, monthly, quarterly auditing of your processes in place just isn't going to be enough. I can't imagine how CFOs wouldn't want to automate their processes, whether it's around liquidity planning, risk management, cash forecasting. There's just so much data coming at companies these days.
Yeah, maybe I can kind of remark on that there, Jill. I think data is a key word in that, right? There's a lot of buzz right now about AI, Gen AI, but it starts with data, right? So any AI strategy or ML strategy starts with data strategy. I think that's a key thing that we're working with CFOs at the moment is understanding the data landscape and not just referring to historical trends or looking at current bank exposures, but actually leveraging multivariable sophisticated models to say where's my data come, where are my AR, my AP activities, where my, what's my CapEx for the next, next several quarters out, and really mirroring that data across different market indicators as well, right? And doing a more, sophisticated liquidity scenario planning to ensure that the CFO that he or she has, again, the right cash allocation in the right market with that right level of risk and cost. Any 10K or 10Q you read would be the liquidity and capital resource section. They'll talk about overall liquidity within the organization. But a lot of the challenge sometimes is the disbursement of that liquidity across the world, right? We're working with a lot of multinational corporates or corporates that are growing very, very quickly, and they're expanding into a new market, a new region. There's various tax restrictions, jurisdiction requirements, to make sure how cash gets into a country or gets repatriated out of a country. So that planning is critical, right? Making sure you have holistic data across your different markets, ERP data in country, understanding your payables, your receivable exposures, and then having a strategy to ensure that liquidity is in the right account at the right time with that risk metric.
Yeah, Jill and Greg, you're absolutely right. And to your point, Jill, about kind of the way that the speed at which technology is changing, it means that you need to be ready for those technology changes as they occur. And often what we see is that organizations have a technology transformation they have to go through, enabled to get to a point where they can even utilize technology like artificial intelligence. So they have to actually first structure their information, structure their organization in a way that allows them to adopt it. So I think it's one of the things, from a strategic perspective, CFOs need to be thinking about is how do I organize my personnel and my data sets so that I can take advantage of the next new technology that's going to really revolutionize the space.
Right. And Zach, I think that's part of the challenge, whether you're talking about AI from a product and revenue perspective, if you're talking about it from a risk management perspective, everybody wants these products to go to market yesterday. And there are integration challenges or cybersecurity challenges. I imagine you work with a lot of financial services institutions, and we are heavily regulated. So it's not something where you can snap your finger and add AI to your story. I mean, there are technical security, a number of challenges that exist.
Yeah, and I think a lot of firms like Kyriba and ICD offer the ability to take advantage of those technologies without having to change a lot of your internal processes. So as we are able to implement them, we already have the security apparatus in place to make sure that your data is secure when you're processing through our platform. But then we can implement and help you take advantage of artificial intelligence and other technologies that will make you both more efficient and give you better insights into your data.
Yeah. And so, Greg, when you are working with clients to overcome these challenges for the integration process or even to launch new processes, what are some of the common challenges that you hear about, and how are you helping them to execute on this?
Yeah, a lot is first understanding their data, right? So I think a lot of the legacy approaches, and we're talking about AI at this point, right? How we're leveraging these data sets, these large data sets to drive more insights and analytics that they otherwise wouldn't know to look for, right? So a lot of that sometimes is for the CFO to really understand the data first, right? Not doing a traditional bottom-up approach and you get submission of, say, currency data or forecast data across the organization. But as we're kind of moving forward now with all these great technologies, all this horsepower that AI is bringing, it's really allowing CFOs to have predictive models that can be validated, by the various different sub CFOs or controls across the organizations to validate these future liquidity requirements and currency exposures. So part of that first is, do I understand my data well in these regions, right? And that's a lot of work that we do, is sort of scrubbing the data, making sure that there's a historical trend that we can build off and improve to our CFOs, because confidence is king, right? If you don't understand the data initially and you don't have that kind of comfort, it's hard to then trust recommendations that come out of these models going forward.
Yeah. I would also argue too that implementing AI, whether you're looking at the CFO function, cybersecurity function, it seems to be unlocking a lot of the silos, because you need to be able to have, an instant bird's eye view over what's happening across the organization. Zach, are you finding that it's helping to unlock silos, as you need to be able to have a more complete view of what's happening in real time?
Yeah, absolutely. I think one of the areas that we've seen a lot of advantage with AI in our organization is in being able to aggregate data from those different silos and bring it to a normalized place where you can compare data sets across the different functions. Modeling something like a bank deposit is very different from modeling a fund and its underlying investments. And so being able to bring that data together, unfortunately, not all of the organizations that you might interact with out there in the financial sector are moving at the same pace. And so often you'll get, unstructured data being sent to you by your investment manager or by your custodian, while you might get an API from your treasury workstation or maybe your commercial banks that you work with. And so the varying levels that the organizations have to deal with within that technology stack, but also within like the frequency of the data, the granularity of that data that's being provided is immense. And so it does create a huge challenge for organizations to try to bring that data together and see across all of those to understand what my total exposure is to an SVB or a Credit Suisse or the next challenging event that occurs in the future.
Yeah. And Greg, it's not only just internal operations. You have to think about your supply chain. You have to think about other vendors that you work with, counterparties if you're in financial services. So it's not just something that you have to think about internally, it's all these different layers, if you will.
No, that's correct. And I think historically that was more of a foundation is understanding that counterparty risk first. Our clients, as an example, Kyriba, its basic level is a bank agnostic electronic banking system, right? So we plumb into thousands of banks around the world. So you're absolutely right, having that kind of real time confidence and comfort. So our clients knew that day what their exposure was to Silicon Valley Bank, in addition to every other bank that they bank with that afternoon. So you're right, kind of first having that real time access to where is my counterparty risk. That's a foundation, right? So you can have a prudent counterparty risk management program as a foundation. But then moving into on the working capital side, as you said, right, understanding my suppliers. That's where AI is very interesting, right? Is there, do I have certain suppliers that are more delinquent on their payment terms, right? If I have 45-day payment terms, I'm seeing a certain behavior, but how can I model that into my broader strategy around liquidity? And then how do I maybe deploy certain resources like a supply chain finance program or other kind of working capital tools that kind of help my suppliers how the liquidity they need to kind of execute their payables back to me as a buyer. So there's a lot of things that you're saying is kind of getting into the details, and that's what's so interesting on this data. It's so vast. The formats are being normalized. We're doing a lot of that, in the bank formats, but also working with all the major ERPs out there in the world to make that data more relatable to end business users, right? CFOs and their teams are not necessarily data scientists, but they need to absorb that data in a way that is understandable, that is transparent from a business perspective, and then drive decisions from that. And oftentimes these are decisions that come from information that otherwise wouldn't even be exploited, right? It's one thing when you run a report, you're looking at a certain data set. Another thing to run analytics on top of that and expose anomalies, risks, trends that otherwise would be hidden. And I think that's what's so interesting now with these kind of detailed models that we're starting to pioneer to really help CFOs accelerate their liquidity performance more than they have in the past.
Right, for sure. Oh, and by the way, you have to present this to the board as well in a way that's digestible. All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.